Real estate can be a great addition to your investment portfolio, but as with any investment, you have to buy right. This spreadsheet can help you do that by analyzing the income, expenses, and debt service associated with a property. By carefully comparing the seller's proposal with your own model of how income and expense should change over time, you can zero in on your expected returns and successfully negotiate a purchase price that will work for you. Before we see how that works, it's worth noting what this spreadsheet does not do. This spreadsheet is intended for multifamily properties. Therefore, it won't be of use to fix and flippers who want to track detailed construction costs. The spreadsheet is also not intended for syndicators who will be managing a group of investors. And at present, this spreadsheet doesn't have facilities for interest-only loans or multiple mortgages. But if you don't need those features specifically, this spreadsheet should be able to handle nearly everything else, whether you're looking at 5 units or 500. Let's have a look under the covers and see how it works. The Analysis tab is where you first start to look in depth at a deal. On this tab, we will develop 3 views or models of how this property might perform. The seller has their point of view, which includes the asking price, rents, expenses, and what type of loan you might use for your purchase. You'll have your own initial point of view, based solely on your research into what the rents and expenses should be in this area. And then there will be a final view, which you will develop and change over and over if you decide to enter into negotiations. The Strategy tab allows you to develop a plan for renovating some of the units over time with the hope of bringing in additional rents. It will also allow you to specify your financial strategy. Will you refinance after a few years, or hold the property, or sell it? The Returns tab shows how your expenses, loan balance, and property value change over time. And the Charts tab shows many of the same metrics visually instead of in table format. That's enough overview. Let's see the real thing. At first glance, there's a lot going on here in the Analysis tab, so let's get oriented. As with all UXX spreadsheets, cells with blue text are where you enter your own data, and cells with green text are formulas and should not be changed. The 3 viewpoints, the seller's, your initial estimate, and your final negotiation, are here in the left-hand column. Metrics showing the performance of the investment are on the right, up top, where you can see them. Other information to the right of the 3 models are supporting details that we'll get to soon. Mostly, you work this tab from top to bottom and from seller to estimate to final. Let's do that now. When you get the marketing package from the broker, simply copy the numbers from their materials into the seller column. This helps you double-check their math and keeps their figures up on the screen next to yours for easy comparison. You can see a set of figures for an example property listed here already. Note the Unit Sizes table over to the right. This is where you specify the number of units and the average rent for each type of unit. Properties should be valued on their current rents, but there's room for market rents too, which we will come to as we develop our negotiated or final column. Also note that all of the figures are monthly averages, even for items that are paid annually or semi-annually, like taxes. After entering the seller's version of the truth, be sure to double-check the NOI and profit after debt service. It can be easy to overlook some numbers while copying them into the spreadsheet. For the moment, we'll ignore this cap rate section and go focus on the estimate column. This column is intended to be based entirely on your homework. That is, the standard rates you would expect to pay for a property in this area. You'll get this information from a variety of sources, such as property tax records, your own broker, your insurance agent, your banker, and so on. For price, we can begin with the seller's asking price, but we'll come back to this later after we finish the rest of the column. Of course, the units stay the same. You can enter your own mortgage details and closing costs. Let's say you've noticed that there are a few inspections that the seller somehow left out of their analysis, so we'll put in an extra $10,000 for those. Note that if you're going to use an adjustable mortgage with a balloon after, say, 5 years, you would not enter 5 here. You would enter your amortization term, which is often either 25 or 30 years. It's probably conservative to just go with the seller's claims of current other income. If you plan to raise fees for parking, storage, laundry, or whatever else, it might be better to save that for the final column. But it's probably fair to notice that the seller has a very optimistic view of vacancy here. 10% is probably more standard. And now for the expenses. It's quite common in the initial analysis to assume that expenses are 50% of net income, and that's how it's set right now. But this table of standard expenses to the right also holds line item detail for every type of expense. Which one you use is up to you, but for now we can set this to use our standard rates. And now we can see two very different views of this building. The seller suggests that the building is operating at an NOI of $15,128 a month, which, when sold for $1.285 million, is equivalent to a cap rate of 9.9. Your numbers suggest an NOI of $10,276 a month, which is a cap rate of 6.8%. If the area usually sells in the low 9s, you wouldn't want to go buy it for a cap of 6.8. The cap rate table shows you the value of your property at 3 different cap rates, based on the NOI for each model. Right now, in our estimated model, it looks like this building should be worth $1.37 million, so we'll go back up to the purchase price and change it. Of course, some of the expenses are based on the value of the building, so when the price changes, so do the expenses. We can refine our price estimate one more time by plugging in $1.436 million. And now we're reasonably close to a 9 cap. Let's leave it there for now. As it stands, the seller is at $1.8 million and we're at $1.4 million. You could say no thank you at this point. You could offer $1.4 million and hope that's not insulting, and either one of those could be the right move. But before we make that choice, let's have a look at the final column. Maybe there's something we could do to reasonably see the building as more valuable. Start with the price from the estimate column, though we'll be back to change that when we get to the end, just as we did for the estimated price. And your mortgage is still your mortgage, so let's leave those numbers alone for now. But here in income, it looks like there's room for some more revenue. Current rents are noticeably below the market. Maybe you can assume that better management will enable you to bring the rents up to market averages. And you might imagine raising some storage fees, so a little more revenue there. And with better management, maybe you could drop your estimate for vacancy and losses a bit. That was worth several $1,000s a month. What about expenses? We already have a property management company. It's probably wiser to assume that your taxes won't go down from their current levels just because you bought the building on the cheap. But maybe you can get the tenants to pay some of their own utilities. As for everything else, let's leave it the same. Now the NOI actually looks better than the seller's point of view, and our cap table suggests that at a 9 cap, the building's worth over $2 million. Well, you're certainly not going to offer more than the asking price. Let's go back and tone down that rent increase a bit. After all, it will take time to phase in those rent changes. Let's go with $26K. Now at a 10 cap, the building looks like $1.567 million. Back up to the top to fix the price. And that will change some of the expenses, but not much. And we're still at a 10 cap. Even if you go to 9, which is reasonable for the area, the value is $1.74 million. This might well establish your negotiating range, with your initial offer somewhere around $1.56 million, and your best and final offer at $1.74. And that's how the analysis tab works. If you're buying a turnkey property, or at least if you don't need renovations to get market rents, this might be the only tab that you really need to look at. But if you're going to have to spend some money and time to do these renovations, then the analysis so far is incomplete. To handle renovations, or to look at what happens when you sell or refinance, we need to go on to the Strategy tab. The Strategy tab begins by bringing forward the parameters of one of your models for easy reference. Right now, you can see it's set to show the seller's point of view. To change this to the final point of view for our negotiations, we return briefly to the Analysis tab. Reserves might be a requirement of your lender, or it might just be the funds you set aside to do your renovations. We have some renovations planned, so let's take a look at those now. We'll spend $4,000 per unit to redo the one-bedrooms in year 1. When those are complete, meaning starting in year 2, we'll estimate that those units will rent for $950 a month. The two-bedroom units will cost $8,000, be done in year 2, and following that, we'll put those down for $1,100 per month. That's a total of $200,000 in renovation costs, which we now need to enter as reserves. The money spent on reserves won't change the calculation for monthly performance, other than making the units more valuable, but it will change our return on investment. Doing the renovations may also change your expected vacancy rate, but that's something we can look at on the Returns tab. Moving along to the exit strategy, there are two types of exits. You could sell or refinance. Let's look at a sale. If we sell in year 3 and are conservative in estimating a higher cap rate, which equates to a lower selling price, then our new NOI and property value are here. We'll need to specify the actual sales price. This is left as an input instead of automatically taking the forecasted value, but for a first pass, let's assume we get exactly what we consider to be the fair market value. Of course, it costs something to sell the building, and also the loan needs to be paid off. The equity paid out at close is the check you take home, but that's not all of your profits. You'll find those tallied in the final results section. Here are all of the cash flows, the return of any capital reserves you were holding, and the equity you took from the property. Subtract out the initial cash investment you put in, and you have a net profit over 3 years of just about $382,000. Scanning to the right, we can get all the metrics on your investment. Enter a 1 here to see the first year cash-on-cash return. Enter a 3 to see the cash return for your 3-year holding period. It improved because the renovations you did in years 1 and 2 generated additional profits in years 2 and 3. The ROI is shown as total ROI for the investment as a whole, the average over 3 years, and as a compounded annual growth rate. And finally, for those who are interested, the internal rate of return is here. All of that looks pretty good so far. Every view of performance is showing returns that are above your goals. We'll check the charts in just a minute, but first it's worth noting that the $200,000 in reserves, as we've entered it here, is assumed to be coming out of your pocket as cash, and that may not be the case. You could perhaps work with your banker to get that $200,000 rolled into your loan. Then, as you're ready to do renovations, the banker will pay out portions of your $200,000 as you need it. You can represent that on our spreadsheet by zeroing out the reserves, which reduces the amount of cash you need to close, then go back into the Analysis tab, increase the price by $200,000, and just be sure to remember that this isn't actually the price you're going to offer to the seller. Be sure to work with your banker on this piece and see whether this type of loan changes your rate and closing costs. For now, we'll just go back and put the $200,000 back into reserves. Okay, the property is performing well at our hoped-for price of just over $1.5 million. In fact, let's take a brief look at the charts. Here we see a number of indicators that show us the expected performance of the property. These two charts look at your cash balances, both incoming and reserves. These two graphically illustrate what will be happening on an income statement and a balance sheet. Total profit, comprised of your cash flows, reserves, and growing equity in the property, is here. And to maintain some perspective while you're negotiating, you can see the proposed price, NOI, and expected profit for the seller, estimated, and final models here. With the strategy you're considering, things look pretty good. By the end of year 2, you've already spent your capital reserves to do the renovations, and the reserve balance is going back up again. The income has gone up. The value of your asset has increased. You're generating substantial positive cash flows. Maybe you really don't want to sell after year 3. Let's go back and look at a refinance after year 5 instead. First, set the exit to year 5. Then be sure to enter some of the appropriate details as determined by your conversations with your lender. We'll assume an 80% loan-to-value ratio for a long-term refinance, and refis cost less than hiring a broker to sell the property. We can throw in some values for the interest rate and the term of the refinance mortgage, and there we are. You walk out of the bank with a check for $491,000, and your property is still there, cash flowing for you month after month. Take a look at the final net profit. At $416K, it's less than the amount of equity you cashed out at the bank during your refinance. How can that be? Remember that the net profit isn't the amount of cash on hand. It's how much more you have now than you put into the investment to get it started. That's why we subtract out the $667K of cash to close. If you've saved every penny so far, you'll have over $1 million in the bank, but only $416K of it is new money. And that's the Strategy tab. We've seen how you can account for reserves, renovate units over time, choose to sell or refinance, and checked out several different financial return metrics. We even dipped into the charts for a bit. But there's one tab we haven't seen yet, the Returns tab. We won't spend too long here because there just aren't as many controls to understand. This tab is all about seeing and possibly shaping the growth of your income and expenses over time. It's based on an inflation rate and a model type, both of which are set way back on the Analysis tab and are carried forward here for reference. The income and expenses are carried forward too in this column. Then, after year 1, they grow at the rate of inflation until the exit year, which was set back on the Strategy tab. There are 3 exceptions, which are the vacancy, concessions, and property management rows. Here you can choose to base the rates on either rents, for instance, vacancy is always a constant percentage of rental income, or on inflation. Our reserve for vacancies would grow at the rate of inflation regardless of how much the rents were. Remember that the figures are always monthly averages, unless, as in row 10, they're specifically labeled as annual figures. And while it's not recommended to override the formulas, you could, in fact, have separate growth rates that you manually program into each row if you think, for instance, that income will grow at 3%, but expenses will only grow at 2%. That's not something the spreadsheet provides, but you could certainly put your own figures in. Those figures will carry back to the Strategy tab and appear in your financial metrics. Toward the bottom of the tab, there are a number of rows that help build the charts on the Charts tab. This section tracks the capital reserves, which you see as being deposited in year 0, meaning at the time of closing, and then they're paid out in whatever year the renovations are done. This section tracks the paydown of the mortgage and remaining balance, and the last 3 lines all contribute to calculating the total profit at exit. But it's also fun to watch the cash flow and property value build steadily over time, so be sure to use those charts to stay motivated. That completes our review of the Multifamily Property Analyzer. With it, you can dive deeply into the details of every aspect of your property, predict your long-term cash flows, and use that information to decide whether the deal is right for you, and if so, what price you can afford to pay.